times, you know, especially for old people. 50 this month, you know, my brain's starting to lose it a little bit. I'm not old. Or he shouldn't admit old. So it's fun. All right, so we're starting chapter 2. And we're going to kind of go through this first part with the terminology and stuff, and you're going to hear a lot of the same thing over and over and think, oh my gosh, shoot me, this is too much. But it's not as bad as you think, so just hang with it. Okay, accounting systems. What we've been kind of doing, bookkeeping. It's designed to show the increases and decreases in each accounting equation element. We've been doing that. And each one of those categories, I think I've already told y'all this. Y'all hear me saying account. Each one of those categories, cash, receivables, and so on, you're going to hear them called accounts. It's a for each of those items. Okay, and we've been using those T accounts. So the account form that resembles the letter T is called a T account. Some of this, like I said, is just terminology. We've really already done it. It's just, all right, so when you have these T accounts, you know, I had shown y'all where like on one side of the equation under assets, you had a plus and a minus, and then on the other side, the plus might be on the other side. It just depended on what the account was. Okay, so one thing about these T accounts, that's gonna be too fat. The left side will always be debit, and the right side will always be credit. We're going to talk about what those terms mean. So that's not going to ever be any different. Which side increases that account will be different depending on what account you're talking about, but the left side will always be debit, the right side will always be credit. Always. So this T account is a simple way to illustrate the effects of transactions on accounts. And we did that with Net Solutions and then that other problem right after it with Wilson Property Management. And I went ahead and put those T accounts in there to kind of get y'all used to seeing them, and because I thought it might be a better way to demonstrate the effects on the accounting equation than what the book showed. So, all right. A chart of accounts. A group of accounts used by a business is called a ledger. And y'all will be using one of those this chapter, and you'll see what I'm talking about at that point. But the simple list of accounts in that ledger, that's called a chart of accounts. So really, the chart of accounts is nothing more than the list of all the accounts that that business uses. So if they have cash, if they have land, you know, if they don't have accounts receivable, it won't be on there. It's a list of all the accounts they actually use. And all those accounts make up their ledger. Okay, so what order do the chart of accounts appear? Your balance sheet accounts will always be listed first, but they're going to be listed in order of assets, liabilities, owners' equity. So think about it just in the same order of the balance sheet. That's the order they'll be listed. And then the income statement, they're going to be listed in order of revenue and expenses. So it's the same order they're listed on the statements. Is that an acronym? Is that what you call that thing? ALORE. An acronym for you to remember: assets, liabilities, owner's equity, revenue, expenses. That's the order for the balance sheet. Accounts, the list. If that helps you to remember funky words. If you know the acronyms help you remember. All right, what we're learning right now is the double entry accounting system. Remember I said everything that has a left has to have a right. Every transaction's got to have at least two parts. There has to be something on the left, something on the right to balance them, right? Okay, so that's double entry accounting. And it's used by all businesses and based on the accounting equation. Again, some of this is, we've already talked about it. It's just putting it down in one place. Okay, so double entry accounting. Every transaction has to be recorded in at least 2 accounts. Otherwise, you're not going to balance. If you only have something on one account, you're going to if you're only going to have one side of it, you're going to be out of balance. And the thing is, if you do a plus and minus in the same account, you've really done nothing if it's the same amount, right? It just kind of washes each other out. So you need 2 different accounts. So total debits for each transaction must equal the credits. And that's that same concept of everything that goes on the left there has to be the same amount of things going on the right to keep it in balance. Same concept, now we're just putting debits and credits. We're naming them. Y'all lost? It'll get better. We gotta apply. You're still just learning terms. Okay, special rules of debit and credit. Once we start applying this will make more sense. All right, so we have to follow certain rules. So when you have balance sheet accounts, your assets, what increases assets is a debit and it's a credit for decreases. So think about it this way. So this is your asset account and this is just general. You've got your debit on the left and your credit on the right. And if you'll look at like net solutions in that other problem, Wilson, you'll see that I have under every asset, the plus is on the left, the minus is on the right. So we increase those accounts by using the left side, and that's a debit. And we decrease them by putting something on the right side. That's why I wanted to use that like that, so it kind of go ahead and get you used to the sight of it. All right, liability accounts, remember they're on the other side of the equation, so you will credit liabilities to increase them. You will debit them to decrease them. So, let's see. We'll put it right here because they're about the same. All right, let's see. I'm running out of room. So your liabilities and your owner's equity will be the same, but we'll just put liabilities here. You've got debit. That's not letting me put the D. Credit. The plus will be on the credit side. The minus will be on the debit side. All right, owner's equity is going to be the same thing. It's on the same side of the equation. You'll credit for increases, debit for decreases. So you could say liabilities and owner's equity. Okay, y'all following so far? I know it's boring. She's yawning. Do you have caffeine today? No? Uh-oh. No Keurig yet?
Well, we have one, but it's weird. So
It might be that one, like that one I have in there where you have to like talk to it just right and hit the button right,
yeah.
make it work. I finally figured it out, but it took me like 3 or 4 tries. All right, so in your income statement, the debit and credit rules, again, are based on their relationship with owner's equity. Okay, gotcha. All right, remember how I said revenues increase owner's equity and expenses decrease owner's equity. So if we credit to increase owner's equity, we will also credit to increase revenue. So for your revenue, and if you don't want to draw these things off to the side, we're going to have a diagram here in a minute, but it's printed out in there. So you don't have to do this necessarily. But the increase will be on the right side, credit. So, and this is your logic. Revenues increase owner's equity. Owner's equity is increased by credits. Therefore, revenues increase and decrease the same way that owner's equity does. So you'll debit for decreases, credit for increases. That's a lot of like I'm repeating myself over and over with the same thing. It gets monotonous. We're almost through with it though. Okay, so expenses, we will debit for increases, credit for decreases, And owner's equity is decreased by expenses. So we're gonna do the opposite thing for expenses that we do for equity. So for expenses, you'll have the debit on the left, the credit on the right, and debits increase. All right, owner withdrawals. And y'all have to understand too, it's repetition again. You'll get used to this. It takes some practice and repetition. Owner withdrawals, remember they decrease owner's equity or capital, so we're gonna debit those for increases, credit for decreases. We do the opposite of what you do for equity. All right. Debit and credit rules for reporting owner withdrawals are based on the effect of the withdrawals on owner's equity, and they decrease owner's equity. We've already learned that. So we'll handle them the opposite way. Okay, here we go. Owner's equity is decreased by withdrawals. We already know this. Okay, so the next thing we need to talk about, normal balances. All right, when we're doing those problems, we always had to get a balance for cash especially. So we added everything on the left, subtracted everything on the right. We usually had a thing, the balance was on the left-hand side, on the increase side. So the normal balance is either gonna be a debit or credit, but it depends on what type of account it is. But remember that the normal balance side is always the increase side. Whatever the increase side is, debit or credit, that's your normal balance side. So like our asset, like our cash, we always ended up with the balance on the plus side, debit side. Cash always has a normal debit balance unless you've overdrawn, which we're not going to do in here. So if you ever end up with a negative cash amount, you probably made a mistake somewhere. All right, and just for your reference, because they have some things like this in homework, if you see these abbreviations, it's debit and credit. Why is it DR for debit? I don't know. It's a Latin word, I think. I don't know. All right, so the rules of debit and credit, just to recap, debit's on the left, credit's on the right. Here's a little diagram of your T account. Just a template. Title means like the name of your account, cash, payables, whatever. All right, and then here is this came out of your book, Exhibit 3. This tells you everything we just went over. How assets are increased and decreased, where's the normal balance, which side, and so on. So this would be a good piece of information to have on your, I did tell you all about that, right? Your memory aid. Your test, were y'all paying attention to that? I think I mentioned it. I allow you on your test to have an 8.5. She's very interested in that. An 8.5 by 11 surface of notes of your choice to take the test. Really. I don't.
Front back.
No, just front. So write really small. Or I had a student in accounting too. He would get all of his pages out of his worksheets and shrink them up really, really small and tape them on a piece of paper or copy them onto a piece of paper. I got tickled at him. But in accounting too, you only have one chapter at a time. So he was kind of able to do that. But this will be something good to have. You can either copy it or write it really, really tiny. I don't care. How tiny can you write? But it's one page of notes you wouldn't have otherwise gotten. And I just believe that you can look this stuff up in the real world. I don't mind if you have some resources to help you. I don't want you to bring your whole book and set some notes in here. And don't depend on it. Don't rely on it. You still have to know how to apply the stuff. Because if you don't, you're still going to bomb. You got to know how to. I've had open book tests and everybody failed it because they were dependent on looking in their book and they weren't real good about how do you apply these things. And so they didn't have enough time. You don't have enough time to go digging through everything. So know it and know your note sheet. All right. So let's do an example just to kind of get familiar with debit and credit. So let's look at each one of these and indicate what kind of entries would be normal in that account, typical. Might be debit only, it might be credit only, it might be both. So we need to indicate which one are the typical entries and what's the normal balance. So remember, you can always refer back to your diagram there. All right, so cash. What would typical entries be in cash? Debit, credit, or both? Is it always increasing? Is it always decreasing? Is it doing both? Both. Because you're going to have money coming in. You're going to have money going out. So it can be both. Okay, and what's the normal balance of cash? Which side increases cash?
Debit.
Debit. Okay. Accounts receivable. First of all, what kind of account is that? Like cash is an asset, right? What type of account is the receivable as accounts receivable? Where does it fall in the accounting equation?
It's an asset.
It's an asset as well. Whoop. I'm gonna break that wire one day. Asset. That kind of helps if you're not sure. Figure out what kind of account it is, and then you can go to your chart. So, what are the typical entries for accounts receivable? Is it always increasing, always decreasing, or both?
Debit. It's debit.
It's going to have debits. Every time you sell something to somebody on account, it's going to have debits. But what about when they pay?
It's both.
Because you have people charging stuff that they're buying from you, and then you have them paying you back. So it's going to be both. All right. So what is the normal balance of accounts receivable? What's the increase side?
Debit.
Debit. Are y'all following? I can't tell. Some of you are just quiet, and I don't want to like put you on the spot, but I can't tell from the look on your face. You better be following. This part ought to be easy for you. Or at least it ought to come back pretty quick. He was here. He was just kind of chilling. I'm not sure if he was absorbing anything or not. You know, sometimes we just have those kinds of semesters, you know, where you just kind of sitting there and you're just there because you signed up and paid for it. I understand. My daughter did like a year of that. Then every semester was worse than the prior. Supplies. What kind of account is supplies?
It's an asset.
It's an asset. So, are we going to have increases or decreases or both?
Both.
We're going both. I mean, because you're going to add to the supplies, but you're also using them, and when you use them, you decrease it. So, what's my normal balance?
Debit.
Debit. And remember again, your normal balance side is the increase side. So, accounts payable, what kind of account is that?
Liability.
It's a liability. Okay, so accounts payable, do we always have increases, always decreases, or both?
Both.
It'll be both. I mean, you're going to be buying things on account, and then you're going to pay the bill. So it's just kind of like accounts receivable. It goes both ways, typically. So what is the normal balance for payables? What's the normal balance for a liability? Which side increases liabilities?
Credit.
Credits. Y'all following what we're doing? It's just kind of repetition that it'll get used to. What about wages expense? It's an expense account. It affects owner's equity, but what does it do to owner's equity? What do expenses do to owner's equity?
Decrease them.
It decreases them ultimately. So what kind of entries do you think wages expense would have? I've told y'all this before. For expenses, you'll always have them go in which direction? So the expenses, which side increases them? The debit side increases them. You're not generally going to have, it's not going to be typical to have a decrease in your wages expense. Because as you go throughout the year, you're just adding more and more to it. You might have a decrease if there was an error made that had to be corrected, but it's not typical. And what they're asking for is typical entries, you know, your average everyday entries. So you're only really going to see debits in your expenses most of the time. You might see a credit if you're correcting something, like I said, but that's going to be rare. All right, what would the normal balance of wages expense be? Debit. That's kind of a no-brainer, because if you'll look at like what's our typical, we decided it was debit. You're not really going to have a normal credit balance in an account that you typically debit. Does that make sense? Some of it's logic. Some of it's getting used to this weird terminology. But, and I say this because I did the same thing, but try not to overcomplicate it and overanalyze it, because I kind of have a tendency to do that, and I know how that gets, and you can make your mind explode that way. I remember those jet commercials, jet.com, where the people's heads would blow off and purple smoke would puff out. I never saw those commercials. Those people were like buying stuff off of jet.com, and they're like, oh, cool. And they were like so shocked and excited that the top of their head purple smoke would come out, because purple was jet.com's. I like purple, so I was thinking, yeah, that's me. That's my head when I get too much in there. Poof, top comes off. All right, Jane White drawing. So a drawing or a withdrawal account. What's it gonna look like? What are the typical entries gonna be? Sean's bored. I can tell. He's bored. It's okay.
It's gonna be a
Or he's thinking, that's what it is. It does affect the owner's equity.
It's gonna be a debit.
It's gonna be a debit. What are the typical entries in that? When we record drawing, we're increasing it. So the typical entries are gonna be increased entries. So that would be a debit. And logically, debits will increase drawing. Drawing decreases equity. So if you kind of go through that thought process, that's a little much for me, but it works. What's the normal balance in drawing?
Debit.
Debit. It's the increase side. What about fees earned? Okay, so fees earned is what type of account?
Owner's equity.
Well, it affects owner's equity, but it's actually a revenue account. So you're not wrong. You're just getting real close. It's a revenue account. So what would you do to increase revenue? Debit or credit? Credit. And that's really going to be your typical entries. You're not going to see revenues going down very often, unless, again, you have an error you have to fix. So that's not typical. That's not your average entries. What normal balance? Credit. I got to figure out how to make some kind of game out of this. That's not so boring. All right, interest payable. What does payable tell you? What does that tell you about what type of account it is?
It's a liability.
Yeah, it's a liability. This would be like interest you would owe on a loan or something like that. But the fact that it has payable in it tells you that it's a liability. It's something that's owed. Just like accounts payable is a liability. Anything you see payable in. And that's one of those keywords that was at the back of your chapter 1 packet. There's the last several pages have keywords and hints and definitions and stuff. If you see payable, it's a liability. So what is the typical entry in a liability?
Both.
It could be both, yeah. Because it's going to increase and decrease. So what's the normal balance?
Credit.
Credit. All right. So let's work through.
Why would you leave the number 6 blank on the account name?
Forgot about it. Account type would be like a withdrawal account. Now, withdrawal accounts affect owner's equity by decreasing them. Does that help y'all to put the type of account on there? It's like reinforcement.
Mm-hmm.
I hope I don't give y'all nightmares. I would have nightmares about little number signs chasing me with pitchforks or something. Huh?
Is that too late?
Too late? You're already having the nightmares?
This isn't going to class. It's on.
That's good. Okay, so let's look at this exercise. And we're looking at these transactions for this dental office. And this is really kind of the same thing we did before with Net Solutions and with that Wilson Property Management. But now we have the pluses and minuses like we did before, even that's really tiny, so I hope you can read that. Now we're going to apply transactions to them, and you'll have the words debit, credit, so you can kind of get familiar with what it looks like. Okay, so I'm going to pull this up where we can see it. You've got your accounting equation across the top, and it looks the same as it did before, except I had some boxes around some stuff. All right, so we're looking at a dentist office and their transactions for the month of January. So on the first, a dentist opens a dental practice by depositing $10,000 into a bank account in the business name. So what happens? What accounts are affected there?
Capital.
Huh?
Capital.
Yes, capital. And then what's the other one?
Cash.
Cash. He's putting money into a bank account, so cash. And then because the dentist is putting money in, that means he's taking his own personal money and he's putting money into a bank account for that practice. So the fact that he's putting his own personal money in makes it an investment. And when an owner makes an investment, it goes to capital. Does that make sense? Okay. All right, so we're going to show this as an increase to cash. So before when we did this, you just had the plus. So we're increasing cash, which makes it a debit. We're increasing owner's capital, which makes it a credit. Because you got the plus side on the right side. That makes sense to y'all? We've done this before. Dental business borrows $100,000 from the bank, so you're going to see a new account. When you borrow money from a bank, you're going to have a notes payable or a note payable. Notes is plural, you know, you might have more than one, but if you borrow money from the bank and you're going to have it more than a month or so, it's a note payable. You're going to make payments on it. It's just like a car note. If you have a car note, that is a note payable to you personally. Who's got a car note? I've got a couple. It's not fun, but I like having new cars, so what can you do? All right, so he borrows $100,000 from the bank. So what happens when he borrows that money? Typically, when you borrow money from a bank, they're either going to pay whoever you're buying from, or they're going to put the money in your bank account, and you're going to write a check to whoever you're buying whatever from. So in this case, we're not told either way. We're going to assume that the bank's going to deposit the money into the business bank account, and then he will have a brand new liability. So we're going to show an increase to cash for $100,000 for this loan, and we're going to increase our note payable for the same amount. So if you were going to open a business and you borrowed money from the bank, and you were using the money for lots of different stuff, like you needed to buy equipment, stuff like that, they're going to put it in your bank account. I mean, you owe them $100,000, but more than likely they're just going to give you the money in your bank account, let you disperse it. If you're buying a car, you'll get a note payable and they'll just pay the dealer. You'll never see it. You'll never see the money. So it just depends on the transaction. But for this one, he's got to buy some stuff, because if you kind of read on down, he's got to buy equipment and stuff. So, and think about what it would take to set up a practice. You know, you got to, if you just go open the doors and you've got an empty space and you've got to start business, well, you got to buy stuff to put in there. You know, you got to buy drills and those awful torture tools. And so on the 3rd, he pays for malpractice insurance for the month. Smart move. So if he's paying for something, what does that tell you?
Spending cash.
Spending cash. So my cash, if he's spending cash, is it going up or down? It's going down. So we're going to show that 2,000 here for spending that money. And then what did he spend it for?
Insurance.
So is insurance increasing or decreasing?
Increasing.
Okay. So we're going to put 2,000 on the increase side. All right, so on the 4th, he's going to purchase some dental equipment. He's getting an x-ray machine, chair, etc. 60 grand. So if he is purchasing something and it doesn't say anything about it being on account, what does that tell you? When you purchase something, you're either going to pay cash for it or you're going to put it on account, which is accounts payable. It doesn't mention on account. So as a result, we can eliminate accounts payable as our option there and assume he's paying cash. So we're gonna show our cash decrease in 60,000. And what did he use that cash for?
Equipment.
He bought equipment. So we're gonna put that under equipment. Now we have $60,000 in equipment. We gave up some cash, we got equipment. And again, notice as we're going through this, for every debit, there's an offsetting credit. It's just like before I said, for everything you post, you put on the right-hand side of a T account, you've got to put something on the left-hand side of a T account. So that's the debit credit balance thing. We're just adding terms to it. All right, so the dentist pays for a billboard to advertise his services for 1 month, $500. So the fact that it says pays,
It's cash.
pays means cash. And if we're paying for something, our cash is going down. So we're going to show that $500 on the decreased side of cash, which is a credit. And then what are we paying for?
The advertising expense.
Advertising. Are we increasing or decreasing advertising? Increasing. So we're going to show that on the previous side of the expense, which is debit. All right, on the 21st, the dentist performed some dental services. And this is a little bit confusing, but some of your problems are worded this way, which is why I put them in the worksheets this way. So when you get to Cengage, you're not wondering, you're not confused by this, because it says the dentist performs dental services for the first half of the month and receives $8,000 for services rendered. Well, it doesn't mention on account anywhere. So we have to assume it's cash. Well, you're thinking to yourself, why in the world did he hold on to cash of $8,000 for two weeks? Why didn't he go put it in the bank? Because we would have a million different deposit entries to make for cash. So this is just a hypothetical for practice purposes sort of thing. Because I have to like make sense out of everything. I'm like, why did he hold on to $8,000 for 2 weeks instead of putting it in the bank? He probably did it, but we're just summarizing the deposits he probably had for 2 weeks. But because it does not mention on account or that he had to bill clients for services rendered, it said he received $8,000 for services rendered. Then we know he's getting cash for doing work. Otherwise, it would have said received $8,000 from patients on account. Does that make sense? Blowing me up. I'm taking my watch off. All right, so if he received $8,000, what's happening there? What accounts?
Cash is going up.
Cash is going up. So we'll put 8,000 on the plus side. And what else went up?
Fees earned.
Fees earned went up. So now he's made some money. Okay. So we have a credit and we have a debit. And that keeps us in balance. If they're the same amount. All right, so on the 29th, he pays his dental hygienist $2,500. Well, what is his dental hygienist to him? She's an employee, as far as we know. Of course, my thought goes, never mind. Anyway, she works for him. So she is wages or salaries, depending on, what you got available there. So we don't have wages, we have salaries. So we're going to assume he paid her for salaries. So the word pay tells you what? When you see pay, you think?
Cash money.
Cash money. And if he's paying her, he's giving up $2,500, right? So we're going to decrease our cash for $2,500. And then he now has salary expense of $2,500. Okay. Last one, bills patients. Bills patients for services rendered that have not been paid. So what's going to happen there? If he bills patients, he's not getting the money. He doesn't have it yet.
Accounts receivable.
Accounts receivable, because it's telling you in the problem they have not been paid yet. So there is no money yet. But if he's billing patients for services rendered, what does it mean when he has services rendered? What has happened?
Fees earned.
He's earned some fees. Whenever you have finished doing the work for a customer or patient or client or whatever, and you fulfilled your duties, then You have revenue whether you got the cash or not. Okay, so let's figure out what our balances are real quick, and then we'll move to the next thing. Okay, so what would be my balance in cash? First of all, what is my normal balance in cash?
Debit side, so 118,000.
Okay, you already added that. Well, no, yeah, you have 118,000 in debits, but you have to subtract credits. Yeah, because it's like your checking account. These are your deposits for the month. That'd be pretty cool. Except that we owe money. The 100 grand's not cool in the note. But these are your deposits. These are your checks. So how would you find your own personal cash balance? You gotta add the deposits, subtract the checks, and that's your balance, right? It's not the amount on that little ATM slip you get. Unless you know everything has gone through. So 118,000 in debits less 53. So my balance is 53,000. Everybody understand how we got that? Yeah. All right, equipment's done, accounts receivables done. We only have one transaction. Really, the only other one we have to figure out is fees earned, and we had 13,000 in total fees earned in the credit balance. Okay. All right, next thing. We're gonna move into, this just shows you a chart of accounts, and I put your order up here. Just remember it's A-L-O-R-E. And this just shows you a sample chart of accounts. Now, the reason you got the 1, 2, 3, 4, 5 is for your benefit. You're not necessarily going to see that on a real chart of accounts. So it's got them listed in the order that we're supposed to list them in. These numbers here that you see, like 11, 12, 14, 15, that's the account number. It goes with the name. It's an identifying number for that particular account. Some companies have them. In fact, probably most do. And some companies, if they're real small, may just use the name of the account. Just depends on the nature of your business. Neither one is wrong or right. It just depends on your business. Okay, so this is an example of your chart of accounts. All right, double entry accounting. We've already talked about this, but just to reinforce, every transaction has at least two parts, and so it affects two accounts is what I mean by that. Debits must equal credits. That's the same thing as assets must equal liabilities plus owner's equity, because your assets have normal debit balances. Your liabilities and owner's equity have normal credit balances, so your debits must equal your credits. Does that make sense? Okay. Journalizing. That's going to be the next fun thing you're going to learn. Now we're going to take this and like actually do what you would do bookkeeping in a business. So transactions, like we've been doing, all this stuff we just did for the dentist's office, if we were doing the books, transactions are initially recorded into a record called a journal. The journal serves as a record of when transactions occurred. When did they happen? Because it has a date by every entry. Did I spell that right? It looks funny when you get it up there. All right, so y'all will see as we do these entries, first thing you have to do is put a date. So you can go back to this thing and you can say, oh, when did I buy that x-ray machine? And there will be a date there, so it tells you when you did it. Okay, this is redundant. The entry in a journal is called a journal entry, but it's terminology you need to know. You've got journal, journal entry, and journalizing. And then we'll have posting. And you wonder why so many people want to be accountants. It's really not bad, though. So many people want to do this, right? Oh, does anybody want to major in accounting anymore? Yeah, you?
Minor in it.
It'll be good for you no matter what you do anyway. I mean, accounting is very useful. You got to be able to read your stuff, huh?
My aunt is an accountant.
Okay, so you know nerds. Who's your aunt?
Rebecca Anhall. She owns Anhall Accounting in Vicksburg.
Oh, okay. She's in Vicksburg. That's probably. I mean, there's only like a million of us, kind of like the lawyers. So like people in the National Guard, you know somebody like, oh, you know so-and-so. There's thousands of people. I don't know why we think we're all going to know each other. It happens though, occasionally I know. All right, so steps to recording journal entries. This is going to be important to you as you go through the process. All right, so the first thing we're going to do is enter the date. And once you have the form, we're looking at the form, it'll make more sense. We're filling this in as something for you to go back to and refer to when we start making these entries. You're going to enter the name of the account to be debited. When we do, and when I teach all the journal entries themselves, probably won't be today, we're going to run out of time, but I'll go back through these steps. I just want you to have it filled in, so you'll have it to go back to when you're doing homework. All right, so let's see if I've got one here. Okay, so this is what I'm talking about. This is a little snippet of a journal. So this is where your date's going to go. And I'm telling you on the next step, whatever account you're going to debit, you're going to put all the way over the left-hand side, and you're going to put the amount that you're debiting over here. When the next step, we'll talk about whatever you're going to credit. You're going to kind of skip over a little bit, and then you'll put that amount in the credit column for that account. Okay, so maybe that'll help you follow what I'm talking about. All right. Step 3, we're going to enter the name of the account to be credited below all of our, we're going to do all of our debits first. Then we'll do all of our credits. I'm telling you that for Cengage, because in Cengage, you can have a journal entry completely correct and you may get a green check mark by everything, but yet you're not getting full credit and you don't know why. If you don't have all your debits listed first, then all of your credits, it won't give you full credit. In reality, I don't care if you have debit, credit, debit, credit, debit, credit. It doesn't matter to me. Because a lot of times when you're trying to determine what an entry needs to be, you kind of do it that way to figure it out. So I don't care personally. And on a test, I don't care. But when you're doing your homework and you're pulling your hair out because you got everything green checked and you're not getting full credit, that's why. Debits first. All right, so enter the name of the account to be credited below and to the right, just over a little bit. It's kind of like tabbing over, indent. And then enter the amount to be credited in the credit column. Believe it or not, this comes right out of your book. It's a lot of words. Okay, so you'll want to enter a brief description of what took place below the credited account once you're finished. So like on that first entry that Dennis made, you could put a debit to cash, a credit to capital, and then underneath it just say, owner contributed 10 grand. Just something to where 6 months from now you can go back and look at it and you can go, oh, okay, that's what was going on. Just a brief description. All right, leave a posting reference. This is something we're going to learn later in the chapter, but just so you know what that means. It means posting reference. All right, so that's how to journalize. Now, when we're trying to figure out, because I've heard y'all kind of say the biggest thing that's hanging me up is what to use. I don't know what to use. So I've got some steps for analyzing transactions, and this helps. So carefully read the description of the transaction. I mean, it's the same thing we've been doing, and determine what type of accounts are affected. Do I have assets? Do I have liabilities? Equity, revenue, expenses. So when I say that, you're going to have assets, liabilities, owner's equity, revenue, expenses. So it's the ALORE thing, yeah. And I literally, people that have had trouble learning how to do these entries, like what accounts do I use and all that kind of thing, I've gotten them into the process of putting it out to the side when you're reading a transaction. For everything you see, assign it an account type. Then the next thing you're going to do is say, okay, is this account increasing or decreasing? So you'll determine the type, and then you'll then you kind of identify specifically, okay, it's cash or whatever. Then for each one, you're going to say, okay, was my cash increasing? Was my cash decreasing? Put a little plus or minus by it. And then once you determine that, you can go to that chart and say, okay, well, since it's an asset and it's increasing, it'll be a debit. And so by doing these steps, you can just about, once you do those steps, you've got your journal entry done. You just have to go write it down. So you don't have to sit there and try to figure out, just go straight from the transaction to the entry if you're confused or having trouble figuring out what's what. Go through that process. And I kind of left that off. You could say and specifically which account. So the first thing you're going to want to do is determine what type of account this, and then say, okay, well, now that I know it's an asset, which asset is it? Then go to is it increasing or decreasing? And since it's an asset increasing, it'd be this. You know, just go through that thought process. After a while, you'll get used to it. Okay. We're going to stop. And we'll start on the strategy next time. I gotta look at your homework. I may not have found anything yet. I gotta see. You're not gonna do any journalizing or anything like that. What you might have is something kind of like what we did in that first example, where you have to say, is it things like this. Just repetition. It helps. All right. Y'all have a good day.